Okay, the markets have changed, and some of the setups that I've been teaching and using for quite a while are now not working, and that's become increasingly the case over the last 6 months in particular. So what I'm going to talk about tonight is what setups do work and why they work, and a little bit about what's happening and what we need to look out for. So what we're looking at is an increasing volume of algorithmic trading going on. High frequency trading. It's been in the press a lot, but tonight we're going to talk about what it is, how to spot it, and how to trade with it. So let's first of all identify what it is. So high frequency trading is basically algorithmic trading. It's programs, black boxes, whatever you want to call them. It's fund managers with huge amounts of money trading huge volumes in milliseconds. And in fact, in 2010, on the 6th of May, the Dow dropped over 1,000 points in 15 minutes. It was allegedly due to a fat finger, but it was programs. Whether or not it was a number of programs kicking at the same time or just one program, I don't know. But judging by the sheer depth of the drop, then it's likely to be a whole host of programs that kicked in. And it's happening in milliseconds, which is why quite often when you've got a big piece of data coming out, you can tend to get even a gap. Even the forex market, I have seen an increasing number of gaps, and traditionally the forex market didn't really gap, but on data moves, gaps are more and more likely. So, I mean, after that flash crash on May the 6th, 2010, a lot of people, and the volume dropped after that because obviously the market took fright of the scale of that drop, and so there's a lot of big drop off in volume, and lots of questions asked about, is this illegal? Well, the authorities are looking at this, but trading is not illegal, and trading in volume is not illegal. Having computers isn't illegal, so the chances of the authorities making any changes to this is not great. So if high frequency trading is going to be more the norm, we need to understand it and trade with it rather than trade against it. Now, I mean, high frequency trading is so sophisticated these days that they even manipulate. It's not just about making a lot of money in seconds. It's about an overall impact on the market and the overall use of high frequency trading over days and weeks, not just milliseconds. And little pickpocketing moves. This is a bigger scope. This is a wider issue, so we need to be aware of it. So, I mean, what's also happening is, just as there are a lot of orders going through in milliseconds, there are also a lot of orders that are holding back the markets. So they're able to to place, because of the sort of leverage they can use on more importantly the volume that they can buy and sell. They are putting big orders in the book and sitting on them, keeping your small order tucked away and further back out of the way until they're ready to release. Then they might remove the order or get that order filled so that the market jumps and overlooks your order. So there have been many cases where I've tried to swing trade a stock, wait for a pullback, and I'm just not filled, and of course next thing I know it's run $1, $2, $3, $4, whatever it is. So this is becoming such an issue that we need to go through it and understand it. So what does it actually mean? I mean, the end result is that some candle patterns just don't work, or others are less reliable. Setups don't work, and on the other hand, you're getting deeper retraces, deeper pullbacks, exaggerated moves, and these algorithms are stop hunters. These algorithms are able to see where the volume is. they're programmed to see where everybody's tucked their stop away. So if people out there are getting stopped before big runs, then that's pretty much what these algorithms are set up and programmed to do. They're out there to hunt, to sweep up the volume, knock as many people as possible out of the trades, so that when they run it, everybody else who wants to be in that market has got to chase it. As a result of the impact of these programs and these black boxes in the market, you're much more likely to get gaps in stocks and like I said, other markets, including Forex. So what are you more likely to see? How is algorithmic trading going to manifest itself? And this is ISRG, which was a great trending day trading stock for quite a while, until last year. You can see it became a victim of high frequency trading. If we look at just the last couple of months alone, you can see it pulls off of this area here. You have a massive support. So all the institutions are buying these dips. A big move up here, then you get a very sloppy few days here, and this is where potentially they're manipulating the market and shaking people out, only to see that hold and do another little run. And I think the sign the institutions are buying it is where you get these lots and lots of little bars. Shakes out the weak hands, but the big money is buying that level, identified that level, and getting in there. And then of course it hits this level here, so it peaks out, starts dipping underneath it, and then you get this gigantic gap up and a very aggressive 3 days push up here, by which time, by the time it gets up to 540, they're done with it, and they're getting ready to get the next move. And all of a sudden you get a drastic move that almost engulfs 2 days of trading. Very shallow pullback into that bar, further selling, and then they just accelerate, they just drop it. They push it up, it looks as if it's going to hold. Look, might see some buyers coming back here, and then they just drop it, and then gap it down and drop it. So it's several things. It's whippy. It's hard to trade normally. It's exaggerated moves, and you end up with a very messy, untidy chart, and yet you end up with a very big move. And even today you can see how on Friday we saw a pullback, a move into a major buy zone. And this is fresh today. I've taken this chart, and you can see how after that buying off that support on Friday, this hammer's worked, and they shoved it right up to 36,363. Okay, so there's a lot going on, and it means you just got to be that much more vigilant. And if you want to get involved in moves like this, you've got to manage your risk and be prepared to change the way you're trading and change the setups to adjust to this. Now obviously the very big markets, like the very extremely high volume like Forex and like the big commodity markets, aren't as prone to this sort of manipulation, but they are still vulnerable. There is still some of this going on, particularly around data moves. So how can you trade with it as opposed to against it? Well, what I'm doing now increasingly is trading with the key pivots. So that's the big round numbers and the key fib levels. and which are going to help you pick up the real major support and resistance levels, because that is what, you know, these algorithmic programs, they're emotionless, they're completely emotionless. There's not a number of traders making decisions and getting influenced by what's on the news, or getting influenced by, you know, what their counterparts are telling them. This is pure, you know, program black box trading, which is, you know, fine tuning these markets to a millisecond degree that we've not seen in the distant past. We have seen a lot of this over the year 2000, and I think there was some examples in going back as far as 2000, 2002, etc., and over the years where this has started to creep in. I think there were many examples in 2009, in the crucial year of 2009 when this was happening, but it's just becoming more and more frequent, and stock trading in certain stocks where stocks are targeted has become much tougher. So as we talked about, you do get stock runs, so you need to take advantage of that. I mean, if you've got a major pivot underneath you with something like pound Aussie dollar, you know, take advantage of buying some of those big round numbers with your stops, just, you know, 20-30 points underneath that big number, which is what I've done today in the pound Aussie. And just be aware of those psychological stops. Be aware that you might get, you know, a little plunge or a little push to the downside as they knock out the weak hands, getting ready to move it. And avoid new positions, particularly near earnings and particularly data. And if you get a big move, let's take a look at a big move. Let me think of a big one recently. I think yeah, I think gold's a good example of this. I mean, gold looked really dead in the water down here, and then suddenly in last night's trading, there's been suddenly a lot of buying coming in here, and here we are shooting up to 1303 from a low of 1280 in just a Sunday open session. And to me, you know, that's not computer. That's not people getting at their desks very early. A lot of that is algorithmic trading. If we look at, let me think of an obvious one. Let's pick another stock. Let's look at something. Whole Foods. This was another one. Let's look at the daily chart. You can see we've got, you know, decent support down here and major area of resistance at around these areas up here at the highs. So you can see where we've got an increasing number of gaps, nice move on support. A lot of institutional buying, judging by these very small little bars. Moves sideways, pushes up, and it looks here. It looks absolutely fine. It looks as if you're going to get another leg up, but it gets close to where they sold it, and then they just yank the whole thing down. Moves into resistance, so they sell. Moves up into resistance, so they sell. Up into resistance, they gap it down, up into resistance. So you can see this was heavily manipulated. Once they dragged this all the way up, then they just sold the heck out of it. And every opportunity they got, they sold the heck out of it until here. It looks as if it's bottoming even when we retest the 50 EMA, it still looks as if it's going to bottom. I was looking to get long this, and they just plunged it, absolutely plunged it. So as an example, so the best way of if you can see something that is manipulated, then one option is just avoid it and just look for a stock that doesn't look as if it's manipulated, it is acting without these extremes and these exaggerations. Otherwise, otherwise just look for these major areas of support and resistance and just trade around them. But if you, how I would have traded this in the past would be to look for stars and hammers, look for clouds and then pullbacks, but there aren't any. You get a nice bar there of support and then it runs. You get a pullback to a 50 EMA. You do get a marginal pullback in that one, so that works fairly conventionally here. But it's harder. It's harder. And so I think we need to. The way I would trade this now. Now I'm more geared up to identifying and trading around high frequency trading. I would just look for key levels. That was a major support level. Sorry, resistance level. That's a major support level. Just sit there. This is what I was doing with oil last week. I was buying at lows and just selling at resistance. Buying at lows, selling at resistance. Rather than sit there and waiting for a nice breakout and a pullback or a breakout. I'm just trading, simpler areas. I'm not trying to get too clever and too involved in a market that is flapping around. Have you got any questions on that? But it is increasingly happening to. If you look at the beans have been behaving wildly recently. If you look at this contract, I bought 14.50 last week in the beans, but they look dead. The contract sells, they yank it up, nice move. And they suddenly just pull the rug from under it and drop it. Sell, and then it looks dead here. It looks as if it's about to roll over to me. To my older way of looking at these markets. And then suddenly it runs straight up to close to 1500. From looking as if the sellers are in control, it just about turns and then does a big 2-3 hour move to the upside, and then what do you know, it hits resistance and the sell programs come in and we're right back to 1465 area again. So it's more volatile, it's more clinical support and resistance moves, and all away from the traditional sort of ebb and flow of a normal trending market. Yeah, you've got to trust. On fundamental analysis, we all know is long since out of the window. You've got to have a greater trust in your ability to identify support and resistance, and be bolder in the way you trade it. Well, if you look at this 60-minute chart here on the 8th, there's no pullback in that 60-minute chart. We had a nice clean close, we close at 14.59, and then we don't pull back into that bar, we don't pull back down to that 50 EMA, we continue to the upside. The only pullback you do get is days later, and that is another sort of recommendation. If you get a chart that is subject to big moves like that, don't get despondent and walk away from it, keep an eye out for a key level where you can get back in a few days later, 1, 2, 3 or whatever days later, and then buy that key support level back. So when we look where we are now, we've got this is closed now. We had 2 nice days up into that, close to that $15 level, and we've had another sell signal. So 2 nice days of buying, and then we've got a sell signal. So yeah, anybody who's trying to buy and hold that is having a tough time. Okay, so what this means is in the videos and in the room, you're just seeing, I'll be doing more key pivotal trades. I have been doing more, and in some cases some people have been getting a little confused as to why I'm buying out and out pivots and not trading some of the more traditional setups. The reason why, one of the reasons why I was shorting this is because I'm just looking to see if any algorithmic programs are going to trip in on this major top of the channel we got going here on the Dow. Yeah, times are critical because of the way in which you're getting algorithmic moves around the data. So timing is critical, and standing aside, if you're not in a trade and you have, or you're in a trade and you haven't got much of a buffer, be very, very careful that it doesn't zip against you. And if something does run away from you and you're not in it, and you particularly wanted to be in that trade, be very, very patient for the next day or two to see if it will pull back. I think something like where there's a lot of volume, a forex pair where there's a lot of volume, like the pound yen, I think is seeing more of this. I mean, look how this pound yen was really nice up into off this fib level. Look really, really good here, and it looks as if a nice pullback to 50 EMA, a nice fade of the 50 EMA would see that move up and push back into areas of resistance. It didn't. It just comes back into this pivotal area, sells, back into the pivotal area, sells, until eventually they start to yank it down. And of course, once it gets to this level here, they start to drag it all the way up again. So it's more volatile, less tidy charts. Yeah, don't forget, I'm not saying that this is happening on every market. Some of the the real big volume markets, it's tougher for the high frequency traders to manipulate, because it means they've got much more money. They're going to have to put bigger sums of money at risk, and they don't particularly necessarily want to do that. So it's less obvious in forex and commodities, but it's still there. And you can certainly see in this oil that we've been playing in very tight ranges. You've got a tight range here, tight range here, a very tight range there. So you just got to, in some cases, just put your order out there, make sure you got a reasonable, a good stop, and trade around it. Okay, well, I've been speaking for, it's 20 to 8 UK time. I've been speaking for 25 minutes. Yeah, just think about what I've said, particularly when you're watching some of the videos I'm producing, and just be aware of it in your trading. What's your question? So look, let me just read that through again to find. Yes, if you get a 100-point move in a forex chart, let's go back to pound yen. You know, if you get a decent move in a currency pair, that's likely to become much more of an obstacle in this sort of environment, even more so than the past. Until eventually this is probably quite something of a stop run. I don't think traditionally that would have dug that deep. I think in the past this 190 would have held, and you will see a nice little breakout, nice little wedge up here, and that would then potentially push back to this area here if it's bullish enough and the buyers came in. But here we get, you know, a big flush right down to this key support level before they start spending a lot of time winding it up again. Yeah. Okay, I'll come back on this and I'll cross-refer to this as time goes on, and we look at more stocks and more charts. But that's what I wanted to you know, relay to you today and get you to see what's happening. Okay, well, I'm going to leave it there. I'll publish this recording. So unless you've got any other questions, I'm going to finish up. If you look at this Dow market today, yeah, we have one big push up in the open, one big bar, which is typical of you know, degree of high frequency trading, and then you get nothing, tiny sort of 30-point box for the rest of the session, and we've got an hour and 20 minutes till the Dow closes, and we're still not doing much. Okay, thanks guys, and no more questions coming in, so I will leave it there. Bid you farewell. I will send you a copy of that recording and look forward to seeing you tomorrow.